Welcome back, passive income investors. Today, I really want to talk about the volatility coming into earnings and why earnings is so important. But man, we are in an interesting time period. These are my two portfolios, as many of you may know, and I'm going to break down what is going on with these stocks. But before I do, let's celebrate the fact that the TSX just reached all-time highs. That is the Canadian version of, the S&P. And in Canada, things apparently are going pretty well, except it's kind of an illusion here because you have to include the loss of dollar value. So our dollar has come down a lot, and you actually have to incorporate this into the value of your portfolio. So from 5 years ago, when we were at par with the US dollar, things were even trading, but now with the conversion rate and the 25% loss, literally all your Canadian dollars are worth 25 cents less globally, and you do have to take that into consideration into your portfolio. So something interesting to consider. But again, celebration, guys. Well, I'll try not to make this too realistic and depressing. So let's get right into it. Alright guys, so let's explain what's going on here. So essentially all of these stocks, almost all of them minus I think one or two, still needs to release earnings. Earnings has not come out for like the majority of my portfolio, like Apple, Microsoft, CM. Most of these companies are at the end of the month or just at the start of May for earnings release. Leading into that, guys, we've had such an uptrend in these portfolios. A lot of my stocks have come back, obviously following the basic index funds as I own. The majority of my companies are on the basic index. They're huge companies like Microsoft, Apple make up huge positions, as we can see in my portfolio, along with Microsoft as well as doing really, really well. My tech sector is back on track. My banks are still flat, but these are dividend holders, guys. I'm not overly concerned. There's been a lot of stress on the banks lately, so their earnings will be very interesting. So the earnings on the banks lately, so I'm sure that's just going to be kind of like subpar, to say the least. But I mean, there's still more bulls than bears currently on a lot of these. But again, I really don't care what happens to these. I'm holding them strictly for dividends. When I hold dividend stocks, guys, it's usually to get paid now. And I'm going to explain a little bit about how I've got my portfolio structured here as well. But moving into my other portfolio, this is this is my TFSA, by the way, and I've got some dividends, which is nice. So I'm going to use that to purchase some more GEO Group, which is one that I talk about a lot. It's one of my big downers right now. It's the only REIT in my portfolio, and I think it's over negative. I don't think it's a bad sign to buy this on this dip right now, so I'm going to pick up a few more when I get just a few more dividends. And we can see I am currently up $4,396, which is at par, because, again, this is still recovering from the crash that happened there. This was a lot higher in the past. But my other portfolio on hand, this one, guys, this one's actually reaching all-time highs again, and this is the money that I got out of selling Facebook. Nice, healthy. I made $500-600, which is going to go to tax money soon. I'm up $2,257 plus the profit that I made selling Facebook. So this portfolio is on fire, except for Tesla, of course. But I'll show you the performance real quick. Let me sweep on over here. So in the performance of my TFSA, this is just for March. I can't show you the performance. I cannot show you the performance for April because we're in the midst of April. But for March, my TFSA was completely flat. But this portfolio, on the other hand, has been killing it with the little bit amount of money in here. I was buying things on really good dips. So we can see we've had a 95.27% return on the money that has been in this account. So if you were new to dividend investing, I want to tell you how I've structured this because I don't think I've explained it very well. And now, it's a good time to just take a breather and just kind of enjoy the pre-earnings run and explain to you why I've structured this the way I have. So essentially, I look at my portfolio is incomplete, and over the next few years, I'm going to see it somewhere sitting between 2 and 300,000 is my goal. So essentially, I look at it as I want, almost a 10 or 15% stake in tech, 10 or 15% stake in utilities, the banks, REITs, drugs, whatever. And I'm just going to pick individual sectors and build it out. And the way I look at this is my tech sector is complete. Between Microsoft, Apple, and Tesla, that makes up roughly currently about 34% of my portfolio. And that to me is complete because by the time I get up to 2 or 300,000, it's going to be worth about 10%. And the way I've structured this is to pick the stocks I think are going to help me grow the best in the beginning. So I'm not going to buy any more Apple. I'm not going to buy any more Microsoft. But while they sit here, because I made them such large positions, they're companies that tend to do very well. So I can, because I'm young, I feel like I can take on a bit of extra added risk and hopefully see some extra growth out of this. And at the same time, I want to make sure I'm picking some really high-end dividend stocks, which again, I don't expect this kind of capital growth from, because I just want the dividend payments. The idea is to get a balance of growth and dividends. If I can just find a nice, even kind of playing ground for it, it makes me a lot more comfortable, because then I'm getting the cash flow to reinvest into companies like Apple that don't pay a high dividend when I am, lacking on my own money to invest. But at the same time, I'm still experiencing the growth and, the increasing that comes from Apple and Microsoft. And by the time, 2 or 3 years passes, I'm hoping Apple and Microsoft are big enough positions that when I liquidate them, I'm going to essentially be able to, well, not maybe liquidate them totally, but, bring them down in size to buy more dividend stocks, but probably more stable dividend stocks, things like, Johnson & Johnson, McDonald's, and start positions in things like Starbucks. But in the early days here, I really need growth and I really need cash flow. So you can see here, I've taken on some really high dividend paying companies like MO, got these in an extremely good dip, I think. But we'll see if they can sustain, guys. Up 22% currently on BTI, and it had a bit of a dip today. I'm hoping we see a little bit more, because these are going to be some stocks I'm buying, but I'll talk more about that a little bit later, guys. So this is kind of how I have it structured. Tesla's the only company I'm going to own in my whole portfolio that will not pay a dividend past this point. I may buy a little bit more of it, but not right now. I just really want to keep focusing on getting these dividends up. STZ, we can see coming up into earnings is, whoa, it's on fire, which means I might have already came out with earnings. I'm not 100% sure of that. I'd have to look into it. But either way, this company, I'm glad I picked up, just a little bit on the dip, and I'm going to buy more of this. I hope it stays somewhere a little bit lower, because all of these drug stocks, I think, are well undervalued. They have not recovered like the market has, and I really don't think these companies deserve to be sitting where they are right now. So I'm going to keep buying a little bit more of them. It's nice to see them still down well below their all-time highs. And yeah, it's a bit of risk, but I'm young, guys, so this is how I'm kind of structuring my portfolio. You can let me know what you think in the comments section below. As soon as I get taxes paid, we'll see how much I have left of this and my other money, my accounts, and that'll be used for investments I will be talking about in the next video. I think I bring it up. I might talk about it briefly. But let me know how you guys have your portfolio structured. I love seeing like Dividend Grinder and a PPC in. There's so many different channels, guys. Financial education. It's just neat how you can see their morality suits your portfolio. Everyone's slightly different and everyone has a different take on their portfolio, but everyone seems to find their own way through it. And I would love to hear yours in the comments section below, guys. So let me know what you think. I hope you have a wonderful evening. Stay cool, guys. Stay awesome. And I look forward to chatting to you tomorrow.